My view is that rates are too high to sustain the system. The system cannot survive.
I am joined, as always, by Joseph Wang of FedGuide.com, and we have a very special guest today. We have Edward Chancellor, investor and a noted author. His most recent book, The Price of Time, is a fantastic book about the history and perhaps the future of interest rates. And Joseph and I, we are just delighted to have Edward here. So thank you so much for joining, Edward.
Thanks for having me.
First question, Edward, I want to ask, just to get at the heart of the matter of the book, is who is John Bull and why can he not handle 2%?
So John Bull is the eponymous Englishman, the sort of archetypal Englishman. And there isn't really an equivalent in America. Sort of Uncle Sam doesn't quite cut the mustard, but it's probably as close as you can get, or you might say John Doe. Anyhow, so John Bull is this eponymous Englishman, and he's meant to be a sort of model of common sense, sort of take no nonsense. However, the 19th century English financial journalist, Walter Bagehot, writing about markets, had this saying that he liked to repeat: John Bull can stand many things, but he cannot stand 2%. Faced with a loss of income, he must either accept that he is less well off, or he must take more risk. I'm paraphrasing. And then Bagehot goes on to say, well, what are the sort of risks he takes? So when interest rates 2%, he goes after what he calls a canal to Kamchatka, which is a reference to the canal mania in England of the late 18th century, in a railway to watch it, which is actually a reference to the railway mania of the 1840s. And then he also says in selling ice skates to the torrid zone, which is actually quite an interesting reference. That's actually a reference to the period of very low interest rates in the early 19th century when Britain was fighting the French and the gold standard was suspended and the Bank of England was just printing out paper money and interest rates were kept too low. And even though the English were at war, they were cut off from the continent, and they got very excited in sort of in emerging markets. And the rumor had it, the city myth was that the merchants were selling ice skates to the torrid zone into South America, where obviously there was no ice. In other words, what he's saying there is that not only do people chase speculative valuations, but they also, even at times of sort of easy money or very low interest rates, pursue sort of chimerical business ventures, which we've obviously seen quite a lot of in the last few years.
Absolutely. I mean, we see that in low interest rate phenomenon very clearly. In fact, I think it's basically a policy of some central banks post-Great Financial Crisis to keep interest rates low to kind of fuel speculation and wealth effects. What I really like about your book, The Price of Time, is that it's such a scholarly book. There's so much history, there's so much research that goes into it. And in fact, you start from the very beginning. Where did we first see interest rates? And as a building block to where we are today. Can you talk a little bit about the historical origins of interest rates and just kind of what role that was played? Obviously, it's been very controversial throughout time. Some people think of it, as you wrote, as a share of profits. Some of them were basically something that's unjust and so forth. But it's a very complicated and interesting history.
Yeah. So first of all, Jason, I'd say I distinguish between interest rates, which is the charge, the percentage charge on a loan, and interest as a phenomenon, of the act of charging, if you will. Now, interest, it goes back to prehistorical period, before we have any human records. And why do we know that? I think we know that because you find in the etymology, in the ancient languages, the various words for interest are linked to livestock. They're linked to calves, to the offspring of livestock, to calves, to lambs, to kid goats. And I think what we can tease out from that is that before any historical record, farmers were lending their property, their livestock, and probably their grain too, to other farmers who were in need. And then they were charging the fruit of that lending. And then when we get into sort of ancient Mesopotamia, we find other functions of interest, which are very similar to what we find today. For instance, Mesopotamia, has these early cities with large populations running into the hundreds of thousands, and they have housing markets. Now, you can't have a housing market unless you have an interest, because unless you have a discount on the value of some future service, like for, a house you live in, and it's delivering its service over a number of years, and if you rent it out, that rental stream of income is coming over a number of years. So let's say you have a house without any, and you have no discount rate. How much is that house worth? Well, that house is actually technically worth an infinity, because if it carries on providing a service ad infinitum, then you've got an infinite stream of income going out into the future, and you just add it all up together. And so that would mean every little hovel was worth $1 trillion more. So it doesn't make any sense. So you have to have something to discount the future services, the future stream of income back to the present. You also find in ancient Mesopotamia that you have small businesses, and those small businesses are borrowing money, and you're not going to have a market for lending money. Why should one person lend another person their property unless there's some reward? Well, there's a certain risk that they're not going to get the money back. So one way or another, you've got to charge for the loan of a property, and as I mentioned, there's got to be a little risk premium in it in case that loan doesn't get repaid. And so in ancient Mesopotamia, for instance, we find that maritime commercial loans, which are obviously riskier because there's a risk of shipwreck, that they charge a higher rate than other types of loans. And we find that, we find, for instance, that barley loans, which are presumably being they're either consumer loans, or they're used for as seed grain. We also find they charge higher rates of interest. So we find very early on a little risk premium in of interest. And I mean, my sort of general argument, I'm not original, my general argument is that life being sort of nasty, brutish, and short, we prefer our current pleasures to those in an uncertain future. And given that we live in a world of scarce resources, and capital is not infinite, people in this era of very low interest rates came to had this illusion that capital was free. Well, no, it's not, and resources are scarce. Given the scarcity of resources, and given our inherent preference for a bird in the hand, something you have now, as opposed to a two in the bush, we will always have an inherent rate of interest. It's something within human nature, I think.
And that was before the time of central banks too. So it's something that, like you mentioned, human nature comes up with it. It's something that is almost quote unquote natural.
So look, we've got 5 millennia of history, and the first central bank is the Dutch Wieselbank, the Bank of Amsterdam, which is created in the early 17th century. And really, central banks, the Federal Reserve doesn't get started till 1914 or 13. And so really the central bank aspect of and their role in interest setting is really very new. I mean, we always talk about now monetary policy and we make interest rates and monetary policy sort of more or less synonymous. Well, I mentioned the book, the first mention of a, so to speak, active monetary policy is actually in the mid 1920s, a reference to what the Dutch central bank is doing at that time. And we're living at that stage in an era which is no longer a sort of pure gold standard. There was never actually quite a real pure gold standard, but we'd moved further away from interest rates being set automatically within a central bank, just determined by the amount of bullion that was in the vaults of the central bank at any stage.
Is a consequence of a move to fiat currency away from a gold standard that interest rates can be set? In other words, what would happen if a activist central banker wanted to change interest rates or manipulate interest rates during a gold standard?
Well, you see, the gold standard system was posited on a commitment to redeem your paper notes in a certain with a certain quantity of gold, and that is that's a legal commitment. And so we always had credit being created, sort of, if you will, a sort of an inverted pyramid of credit created off a base of gold. But what would happen is that once you create too much credit money, and that leads to a large amount of demand and to rising commodity prices, and at least in theory, and this was observed, back in the mid 18th century by the Scottish philosopher economist David Hume, at least in theory, if you create too much money, paper money, credit money, you create an inflation. The terms of trade of a country deteriorate. The gold then leaves the country, and as the gold leaves the country, the central bank sees the amount of gold in its vaults decreasing, and they see that the coverage of their paper notes is inadequate. And that's when they start that you don't need an economist. There are no models. You just say, hang on a sec, what is our coverage? What is our paper coverage relative to our bullion? And then you say, okay, we're going to hike rates. And in the 19th, I think in the 19th, I don't know when it started, but they used to have a flag on top of the Bank of England that would notify the ships in the docks of what the rate of interest was. And the gold ship, sometimes a gold ship would be sailing towards America, and they would see that the Bank of England had raised rates, and the ship would then turn around and bring the money, the gold, back to England. So you can see that the sort of the money supply and the coverage of the money supply, or the coverage of the credit of the paper money by gold, more or less automatically determines the rate of interest. There's no sort of human agency. But once you get rid of the gold standard, then of course you enter a world in which the base rate, the policy rate, is determined by politicians, by economists, by central bankers. And this is very interesting. We have, as I say, this 5 millennia of history, and you see, you see periods of interest rates changing, coming down and going up at times, but really they are within a certain bound. Very early Mesopotamian interest rates were, as I mentioned, I think 33% for the grain loans. So that's very high. And I think I'm right in saying that I think they might have gone down below 2% in Holland in the late 18th century, let's say. So you've got a bound. Now go into the 20th, go into the 20th century, go into the age of paper money. You get in Germany in the 1920s, during the hyperinflation, in interest rates up to 5 figures. So you get it into the tens of thousands. And then you see that again in South America, Brazil, I think Argentina, also up into the tens of thousands. And then, and this is in a way why I wrote the book, is in the last decade, we get an interest rate of 0 set by the central banks. And then you get interest rates of less than 0 in Europe from the ECB, the Danish central bank, and the Riksbank in Sweden, and also in Japan. So you got, I think it's something like 800 million people were living in countries with negative interest rates. Now, we had never seen negative interest rates in history. Now, if you accept my argument, which obviously I think is irrefutable, that interest is a sort of human phenomenon, is necessary, has always existed, then to do away with interest or to turn it negative is really an extraordinary thing to do. Now, as you mentioned the title of my book, The Price of Time. Interest puts a price on time. Ben Franklin says here, time is money, time is valuable, time is man's most precious possession. So what is a negative interest rate? A negative interest rate is a negative value on time. And that would be like having a watch that actually moves counterclockwise, in which you're actually moving back in time. It's an extraordinary thing if you think deeply about it. And my argument is that people who originated these negative rates just simply didn't think what they were doing. They had not grasped the enormity of what they were dealing with, and that, obviously, that is in itself a really interesting story.
Sorry to interrupt. Wanted to let you know about Blockworks' upcoming crypto event, Permissionless 2. This ultimate DeFi gathering will be taking place in Austin on the 11th to the 13th of September 2023. It will feature the very best discussions on ZK tech, rollups, account abstraction, MEV, and much, much more. All the big hitters in crypto are going to be there, so if you're into crypto, you need to be there too. To get a 20% discount to a full 3-day pass to Permissionless 2, click the link in the description and use code GUIDANCE20. That's GUIDANCE20. Thanks, and let's get back to the episode. And what were the goals of central bankers who lowered interest rates to 0, or in the case of Europe and Japan, to below 0? Why was 0 not enough for them? Was it just that they wanted to stimulate the economy and the economy was still in recession? So they said, hey, if 0 will stimulate the economy and it's not enough, we got to go below 0.
It wasn't really just a question of stimulating the economy. They, as I point out in the book, the central bankers around the world become fixated with inflation targeting, and the inflation target that was generally accepted was 2%. And they had a horror of deflation, of falling prices. Now, again, as I argue in the book, deflation, falling prices, is what makes people better off. I mean, if you have some money in your pocket and your stuff is cheaper, the car is cheaper, your washing machine's cheaper, your computer's cheaper, you think, great, yeah. Well, that's not how the central bankers looked at it. The central bankers took a very narrow problem with deflation, which is, and it's not only narrow, it's actually theoretical. When I say it's theoretical, it's not even quite clear that it actually means anything in the real world. That's what I mean by theoretical. So there is this famous paper written by a great economist called Irving Fisher in 1933, I think, called the Debt Deflation Theory of Great Depressions. And what Fisher says then is that in a world, in a banking world, when people paid back their loans, the banks create less money, and when they create less money, the price level falls. And what can happen, and I'm saying this is theoretical, it's not, is what could happen then is that through the act of paying back your loan, the money supply might contract and the price level falls. So you would actually end up owing, in theory, more than you started to than you owed before you paid back the money, which obviously not a very good thing, particularly if everyone's doing that and the banks start and people who owe money start getting bankrupt. But so that's theoretical position, but in fact, actually, historically, it's complete nonsense. Throughout most of the 19th century, we had booms and busts in the 19th century, but throughout the second half of the 19th century, prices were continually falling, and people were getting, the working persons were better off with falling prices. Anyhow, there was this horror of deflation, and there was this horror of missing the 2% inflation target. So the moment inflation, the recent print on inflation went sort of anywhere close to 2% or just below 2%, then they said, okay, hang on a sec, let's take our interest rates down to zero. And if that's not enough, we'll take them down to negative. And if that's not enough, we'll engage in quantitative easing. And if that's not enough, we'll do any number of different things, little tricks that we can get up to. But my own view was that actually, and as I make it clear in the book, it's a nature of a capitalist economy to innovate, to improve, to generate productivity gains. And left to their own devices, productivity gains will give you deflation. They'll give you falling prices. It's what we, think of Moore's law and semiconductors. Yeah, I mean, do you imagine if the central bankers, if we only had one thing in the world, a semiconductor, and central bankers said deflation of semiconductors is, really a terrible thing. Well, you can imagine the amount of money they would have had to print in order to prevent the price level of a semiconductor from falling. Well, they would have been, according to Moore's law, I can't quite remember whether they have to be doubling the money supply every, year or so. I mean, anyhow, I think it was misbegotten, and I think it was misbegotten because the modern central bankers are theoretical monetary economists who, with little or no experience, no banking experience. It's remarkable that during the global financial crisis, at the time of the Lehman bust, there was not, it's the first time in history, there was not a single person on the Federal Open Markets Committee, the interest rate setting committee, the key committee of the Fed, not a single person with banking experience. You had, Ben Bernanke, the former head of economics at, I think, Princeton. You had this guy Fred Mishkin, who was actually on holiday, believe it or not, skiing. The rest of us were like working in the financial world. We're going, this is you weren't leaving your desk. This professor of economics was off on a skiing holiday. Apparently had to sort of put in his vote on a cell phone because he's had so little understanding of what's going on. Anyhow, there we are. I mean, that's well.
I can definitely tell you from my experience that many people in the Fed who have very senior positions are basically there as lifers. It's largely a tenure-driven system.
Joseph, I mentioned that the Fed itself is the largest employer of monetary economist PhDs, and then the Wall Street Journal did a sort of amusing poll, or published an amusing poll after the financial crisis, in which they asked the general public, was the Fed in any way responsible for the for the global financial crisis and the low interest, the easy money of the Greenspan era and so on? And the general public said, yeah, sure, of course. And they asked the monetary economists, say, oh, no, the Fed did nothing wrong. And it's that, it's problematic that in a way the Fed and all the central banks have become major employers of the so-called monetary experts, because what that creates is groupthink, and anyone who with a dissonant view obviously has to leave.
Yeah. So what they often teach, let's say in economist school, is often an interesting idea, but there's often a big gap between how the world actually works and what they teach. And if you go to economist school and you work on the street or in the city, you realize that. But then if you stay in a central bank your whole career, that you don't.
That was nicely expressed by Fisher Black, who was great economist who died 20 odd years ago, and I think Fisher Black was at MIT, and then he went to Goldman's, and Fisher Black said the markets look much less efficient by the banks of the Hudson than they do by the banks of the Charles. So if you're MIT offices overlooking the Charles River and you've never actually sort of muddied your hands in finance, you can create these models of rational expectations and so on and so forth, equilibrium and so on, where at the moment you go into the real world, you realize that stuff is a bit more topsy-turvy. Having said that, you're probably aware that Bill Dudley, who was the president of New York Fed, did come from Goldman's, and there is one aspect of monetary policy which isn't entirely a problem monetary policy, which is not entirely to do with theory, which is, I think, that sort of the central bank policy became captured by the interests of Wall Street, sort of mediated through the likes of Bill Dudley, not necessarily consciously, but if you read the FOMC meeting notes, and it was in the immediate period of the post-crisis period, it's Dudley who's always warning about the danger of financial instability. And if you remember, after we were told that these zero interest rates were going to be a short-term phenomenon. They were just to deal with the aftermath of Lehman, and and this was just lender of last resort activity. And then they went on until last year. So actually, it was a full business cycle, more than an average length business cycle of zero rates and quantitative easing. And the rationale often, was always really, it was a bit to do with lowering inflation, but if you read the notes, it's always to do with, if we keep, we're seeing problems with, in the plumbing of the financial system, with, or we're seeing problems in Europe. They always find another reason to loosen, and by remaining loose for very long, and this, as you know, is sort of one of the arguments of my book, is they actually create these asset price bubbles and create this leverage and this yield chasing, this risk-taking activity that always gives, and having created this monster of fragility, they then also gives them an excuse to continue remaining loose. And they would definitely have remained at zero forever unless inflation had come along.
To your point, Edward, I think there's a lot of news right now suggesting that, some politicians are suggesting that maybe the inflation target could be moved higher, which is, of course, another justification to not hike interest rates or maybe lower them again. Now, Earlier, you mentioned that there's this big shift to an inflation targeting framework that basically uh, dictates how the central banks set their interest rates. And we had a huge anomaly where rates were largely negative for a period of time. And obviously, in the absence of a central bank, it's hard to think of anyone who would lend to someone at negative interest rates. It's really bizarre.
I mean, you can be quite categorical. Is a negative interest rate is a tax on capital. So you would stuff your money under, in a safe or under your bed than have your capital taxed. And that's actually what we saw in Japan and Germany is, when the rates were not actually charged on consumer lenders, but they were charged on the banks themselves. And I think, one of the large German banks, Commerzbanks, did actually start hoarding notes in safes. And in Japan, actually, there was when negative rates were announced, there was a sort of massive sales of safes, of domestic safes. So yes, categorically, you could not have negative rates coming about except under central authority, central planning.
One of the favorite charts in your book, Edward, is the U-shaped interest rate curve over time. That is to say that in ancient Rome and in ancient Greece, in the beginning, interest rates are high, and then they gradually lower and lower in correspondence to the rise in power of the civilization. And then afterwards, the interest rates kind of go high again, like a U-shaped. And when you look at what's happening in the world today, our interest rates were high. They've been low to negative for a period of time, and now they're rising again. What do you think is like the fundamental underpinning between this U curve that we've seen in the past with other civilizations?
When a civilization establishes itself, it first of all, there will be, in the early days, there'll be more risk because it's not secure, and there will be relatively few savings, surplus. Savings is, after all, the surplus of a society, and there will be very relatively few institutions, banks, call them what you will, to intermediate the savings that exist. So, look, if we all were to say we had a little bit of surplus, let's say grain surplus for one of those, and we just kept it at home, well, then the cost of borrowing the grain would be, over time, and repaying it would be relatively high. So the moment you have middlemen, bankers lending money, then you're going to get interest rates coming down. And then when a civilization is established and secure, then you get the sort of bottom of the U shape. And then as it collapses, well, then you get more risk because the civilization is on its last legs, and you get fewer savings, and probably the intermediaries start failing, and so you get this U shape, and the U shape, that period is indeterminate. And what I say is in the book is, we've been living through the lowest interest rates in history. So you do see a bit of a U shape. Is not really comforting. The other thing I say in the book, which I think is important, it's not my own, not a point I made myself. I got it from the Great History of Interest Rates by Sidney Homer, which is that people always think that the interest rates they experience are normal, and then they're always surprised by the interest rates that come next. So it's very difficult to predict the direction of interest rates. It's very difficult to predict these cycles because we have, as I mentioned in the book, 30 to 40-year periods of declining long-term rates, and then sort of similar length period of rising rates. It's very difficult to make the call on that. I mean, I think I actually have to say, I think I did, having worked on this subject for such a long time. By 2021, I sort of could see that we were at the cusp of a change in the interest rate cycle, but it was very easy to be early on that one. So I don't know where the interest rate's going now. I just know that even I, who spent years thinking about it, am going to be surprised. And if I'm going to be surprised, you can be sure as hell that everyone else is going to be really surprised. And look, think about, and we'll perhaps get on to it in a moment, but over the last year and a half, not quite a year and a half, year and a quarter, let's say, interest rates started to rise, and that has taken a lot of people by surprise. So, the most obvious case being Silicon Valley Bank, which had had this great inflow of deposits during the sort of last gasp of the venture capital boom in 2020-21. Poor old Silicon Valley had money pouring into it. The VC guys coming with sort of sacks of cash, saying, and they didn't know, and the Fed funds rate was zero. So they said, they were trying to be good. They will buy risk-free U.S. Treasuries, and trouble is the risk-free U.S. Treasuries at that time were at the lowest. Let's say the 10-year yield was at the lowest level in history, and nature of banking, you gear everything up. So they just had a geared leverage position in 10-year Treasuries. I'm not saying that I don't know if they had 10-year Treasury, but longer dated U.S. Treasury, and that was, they must have assumed that interest rates would remain low and that therefore they wouldn't have capital losses on those treasuries. And if you remember, back in 2020, Jay Powell, the Fed chairman, said, I'm not even thinking about raising interest rates. So you could see that if you were a sort of CFO and in charge of the sort of the bank's books, you might have thought you were being reasonably prudent in what you were doing, and it actually turns out that you, along with Jay Powell and everyone else, had not known the direction which interest rates were going.
And we're going back to sort of the theme of John Bull can't stand 2%. You mentioned venture capital. Can you talk about the proliferation of investments that really boomed from 2009 until basically now? Private equity, venture capital, growth-based equities, maybe some fixed income strategies that work well when interest rates are at zero. How much do you attribute the success and the proliferation of those investment strategies to low interest rates?
Well, I would distinguish VC from private equity for stuff. Private equity, I think, is a bit more straightforward because, again, private equity is a fairly big business. But let's imagine private equity is just the old-fashioned buyout business. Well, the old-fashioned buyout business is financial engineering, where you replace equity with debt, and the idea is that as long as you can borrow cheaply enough, you can lever up a business and in time pay back the debt and sell your business at a profit. I think the private equity business kicks off in 1982 with former Treasury Secretary Bill Simon's leveraged purchase of Gibson Greetings, which is a card company. And I think, I can't remember, I think Simon himself turned his $750,000 investment into $80 million. But for the investors, it was hugely profitable. And really, the private equity guys, they're more like corporate financiers or investment bankers than traditional investment guys. It's all about how much debt can we put. I'm just talking about the LBA. It's not some of the other stuff. And so I think that is, that entire business was grew. It developed on this long, during this long 40-decade bond bull market of ever declining rates of interest. And then what you saw at the end was higher the buyout industry was putting more debt relative to operating cash flow to EBITDA. I think industry average, let's say 8 to 9 times, which is historic high. And as I mentioned in the book, at the same time, the loans that were being put out were advantageous to the lenders because they didn't have covenants, and that sort of these so-called covenant-like loans means that the creditors, don't get to take the company back because they're loose on covenants, which actually they're basically like giving a sort of free call option to the buyout people, to the borrower. So there's hugely advantageous. And then you throw in the facts I point out in the book that that the low interest rates also feed general asset price inflation. So you can see cheaper funding and asset price inflation. How's private equity not going to make money under those conditions? And and I suppose my view is that party is over, and so anyhow, so that's one part of the story. The VC business, venture capital, slightly different, but also affected by the low interest rates, and I would say in two ways. One is to go back to Walter Bagehot. If your returns on your tried and trusted investments are not what they were, then you must venture more. You must be less safe. And obviously, a venture capital business is less safe, and so you get this flow of money into technology. And the other is to do with the discount rate. If you apply a low discount rate to a venture capital business whose profits lie some 10, 20 years in the future, well, the low discount rate will inflate its value, its residual value, and so your asset will be worth more. So you've got more money coming in to assets that can plausibly be valued at a higher level. And then you've got these frothy bull markets where the game is really with VC to ratchet up the pre-market valuations. Most of the speculation really is taking place off market, which is sort of, to my mind, is a sort of first time I've ever seen it. I never read about it in other markets. Normally, normally these venture capital businesses go to market as quickly as possible. But here, with the Ubers of this world, with the WeWorks of this world, they were being ratcheted up. And then eventually, when they were sort of fully multi-billion value, there was an attempt to throw them on the wretched investors in the market. That slightly changed right at the end with the SPAC boom, whereas, these very, what do you want to call them? Conceptual, fraudulent.
Very conceptual.
Fraudulently conceptual businesses were being, quickly spun into these special purpose acquisition companies and floated on the market.
So one of the things that we saw in this low interest rate was the giant boom in VCs and so forth. And some of the proponents of a low interest rate policy would talk about how if you have low interest rates, you can fuel all sorts of investments. That's really great for progress and so forth. But in your book, you take another view that I found really interesting, in that low interest rates can actually decrease productivity growth and actually lead to slower economic growth. Can you tell us a little bit how that might work, that mechanism?
Yes, I mean, first of all, we have to just go back to the point I made already, that capital is scarce, and so it's sort of better for the economy, for society, that every every dollar is carefully invested and well allocated. You can have a speculative boom, and it funds a whole load of ventures, and it may be that a few of those ventures come out of it robustly and have a future, but it seems to be often the case that the vast majority of money is simply wasted. I think if you look at the great tech successes of the last 40 years in America, the Cisco's and Microsoft's and Intel's, none of those businesses came to market during speculative boom, nor did Google, actually. I mean, Google came to market, I can't remember, sort of 2003 or thereabout. Perhaps it was even a bit later than that. Perhaps it was 2003, 4. I suppose think of the first crop of dot-coms. The only name that really sticks out is Amazon. The rest of them, pretty, I think by and large were failures. So I think that's problematic. Although I don't completely write off the idea that there is something that there is something natural about a speculative mania or bubble in a new technology that does encourage a huge amount of innovation. And I think you could even apply that to the crypto stuff. I mean, as you know in the book, I'm fairly dubious about cryptos, and I do say, even I think in the last paragraph, that there's that while crypto may be an answer to the terrible problem of setting interest, and that the crypto world seemed to be, from what one heard, beset with pyramid schemes and so on. And lo and behold, what do we get? The crypto winter with all these pyramid scheme operators going bust. So there may be some function for speculative bubbles in bringing forward new technology, but by and large, capital is wasted. With regards to low productivity, my argument is that at very low interest rates, you dampen the paces of creative destruction. You allow the converse of the unicorn is the zombie company. The unicorn, in a way, is like Icarus. It flies to the too close to the sun, and then its feathers burn off and it sinks down. The zombie is just it lives in the corporate graveyard, but it should be dead, but it isn't dead. And one of the functions of interest is to slay zombies. I mean, that's what's interesting. All you have to do is to turn the heat up on the zombies, and they will keel over. It's pretty easy, actually. But if you keep interest rates at zero, and I think in Europe, believe it or not, there were even high yield companies with low credit, which are actually issuing bonds with negative yields. So you were actually, I don't know if those were technically zombies, but you were, in a way, you're subsidizing inefficiency. And if you're subsidizing inefficiency and the zombies don't die, you diminish the creative destruction in an economy, and you diminish creative destruction, which the Austrian economist, Harvard economist, Joseph Schumpeter, said was the most important feature of a capitalist economy. And bear in mind, Silicon Valley loves Schumpeter. They love creative destruction. Of course, but Silicon Valley also loves easy money.
Well, they're all libertarian. They're all libertarian, except when their bank goes down.
Yeah, they're all except in a banking crisis. They're libertarian on paper. There would just be many fewer of them, as we see. That the startup is a low interest rate phenomenon. Or, do you remember I cite Jim Grant saying that unicorns, a little known fact, that unicorns feed on interest. The lower they like them, the lower the better. But anyhow, go back to the zombies, is that if you misallocate capital and trap it in low return businesses, then you do that enough, you will affect productivity for an economy. You dampen creative destruction, you'll get no productivity, and that's that is obviously a problem because as I said towards the end of the book, that the buy-in to capitalism, system based on whatever you want to call it, greed, inequality, whatever. The buy-in is that it lifts, the rising tide lifts all boats. But if the tide doesn't rise, the tide gently ebbs out, then people are going to be dissatisfied, which is clearly the case.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto, a smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. Right, you challenge in the book the argument that high interest rates or non-zero interest rates help wealthy people because they're the ones who have all the money, so they should be, making loans and their return will be higher. But you make the point that actually, so many wealthy individuals and companies in America and around the world are actually immense borrowers who are, short capital, not long capital, and if they own a lot of stocks, not a lot of bonds, and those values skyrocket when interest rates decline.
Yeah, I mean, look, the point I make is that those who are closest to Wall Street have the lowest borrowing costs. In an age of financial engineering and in asset price inflation, those people will do best. I mean, I remember back in 2014, a friend of mine, retired hedge fund guy, rich guy, he said he and a bunch of his people had bought some, I remember what it was, sort of local telecoms business or whatever, and they'd levered it up. They were with non-recourse loans, and they were going to make tons of money. There was no way that they weren't going to make tons of money. And and if they weren't, if they didn't make tons of money, the loans anyhow weren't recourse to them. So it was just it was very sweet if you were the right person in the right place. Now, if you don't have very much money, then you have to keep a greater share of your savings on deposit, because we all of us worry about our worry that our stream of income, our jobs or whatever, in my case freelance income, might get terminated or something affected. So you need to keep some precautionary savings, and precautionary savings, if you're less well off, are a much larger portion of your total wealth, and therefore you suffer proportionately much more at the low interest rates. And as I mentioned in the book, the low interest rates after the Lehman bust actually coincided with the banks ratcheting up the rate of interest on their loans to individuals, to less creditworthy individuals. And as for credit card charges, they still remained at their 24-25% APR, completely unaffected. So yeah, I mean the whole thing was it wasn't deliberately geared, because I mean one would almost prefer it if it was deliberately geared, like I'm just going to help the private. It was just done without thinking. But I've been reading a book. I read a book last week by this Russian American political scientist called Peter Turchin. Does that mean anything to you? So Turchin, his study of what he calls cleodynamics, a sort of quant history, if you will. And he says that that there are these periods of rising inequality and that end in what he calls elite overproduction. Many people
Oh yeah.
fighting, and he says that comes about because there's what he calls a wealth pump, and the wealth pump is pumping from the poor, taking it, or he also calls it the Matthew effect, and I think I use that line from from Matthew, that to the rich shall be given and the poor shall be taken away. And Turchin says it's the wealth pump working that that creates this long period of inequality and elite overproduction, which then takes the society into a position of imminent crisis. And Turchin thinks that that's where we are today. And I argue that that wealth pump was the very low interest rates, and the people who designed the wealth pump, put it into place, just didn't understand the nature of the machine that they had created and were in constant denial about it. If you read any of the commentary of the central bankers on inequality over the last decade or so, you can see that they are sort of aggressively in denial. And Joseph, you remember there's another, I think my favorite chart in the book is the one in which I show that I think it's income inequality of the top 1% of the US population for moving inversely, moving with total returns of US treasuries, which is really saying that as interest rates came down over the last 40 years, that inequality, that there was a strong connection. I'm not saying causal connection, but you can make an argument, as I do, that they are linked. And if you remember, what I argue is there's a famous Thomas Piketty formula that when the rate of return, when R is greater than G, that higher inequality. And I say that Piketty, you've got to think, typical academic economists got things completely the wrong way around. It's when R, the rate of interest, is below G, that you get rising inequality. There's your wealth pump. And we saw it in the Gilded Age in the US in the late 19th century, of falling interest rates, of financialization, the creation of these monopolies like the US Steel and so on. And we see it again, the creation of monopolies, cartels, of financialization and so forth. So we've been, Turchin says we've been living through a second Gilded Age, and the thing that connects both of them were these long periods of declining rates. It says the bad news is that the rates were even lower, most recently.
And so, how do you determine how high rates can go? If it's clear that zero rates have a whole host of consequences, how do you determine what is a sufficiently high interest rate that society would not want to go above because it would be too high? People wouldn't borrow enough money. The economy would enter a recession.
Well, that depends on any number of different factors. I mean, and I think look, it's clear. I think we all agree that it's difficult to know the relationship between the interest rate and inflation and how ratcheting up the impact of raising rates and inflation. It can happen with a time lag, and it varies over with any number of different factors. I mean, one point that a friend of mine in a piece was writing this week is that in the days when we had relatively closed economies, it was sort of much the relationship between interest rate and overheating and bringing the economy down was quite straightforward. Now I have to say it's a lot more complicated than that. My argument in the book is that interest rates have gone down and down and down, and wealth has gone up and up and up, and debt has gone up and up and up, and therefore the system is much more sensitive to rising interest rates. And I'd say that what I handed in the book, to the publisher beginning of last year, and before the Fed had raised rates, and I'd say to some extent, my argument has been vindicated, but not 100%. Because if you were going to say, if you're going to say take my argument full face, take it through, I'm saying that the system is very resistant to a rise in interest rates, and that the system can fail, a highly financialized system can fail at very low rates of interest. Now, US and the UK is, absolute basket case in many ways, but it's still, the UK is a sort of zombie economy, but still sort of trudging on. But for how much longer? I don't know. So my view is that already interest rates are too high.
Oh,
yeah. My view is that rates are too high to sustain the system.
Mm-hmm.
The system cannot survive with such high rates. So in a way, under that view, you would see the recovery of the markets this year. I can't remember when they turned in October of last year, but relatively very strong recovery of the markets in January. And you've got resurgence of speculation because we talked about VC, and even though you've had a downturn in Silicon Valley, all those SPACs, not all of them, but by and large.
An AI company just got a $4 billion valuation, and it's a few years old.
Yeah, exactly. And you've got is it NVIDIA? Trading $1 trillion company. I don't know how many. Is it 100 times sales? I don't know. You tell me. It's pretty speculative, and then we're back in the fear of missing out. So yeah, it looked, and so Joseph, worked briefly as intern at GMO, where I used to work, and my old boss, Jeremy Grantham, his view is that we're in just a classic bear market rally, and that it won't last, and that's that's my view really. That I would the one nice thing about both working as a historian and working as a contemporary in the contemporary financial world and investment world is one is constantly surprised and constantly wrong. So you don't want to take what I say with a pinch of salt, but my hunch is that we're not anywhere near over with this, and I have to say I'm pretty surprised that that the US, UK are not in recession now. If you'd asked me, beginning of last year, I don't really like making predictions about GDP and that sort of thing. Mm. But if you'd asked me if interest rates had to ratchet up to this, would I think these countries were going to be in recession? I'd say, yeah, probably. So I'm still waiting for a shoe to drop, but we'll see.
And if you think that, Edward, so many people must think that as well, because you literally wrote a book about the consequences, negative consequences often of zero interest rates. And so even having written that book, you actually think that 5.25% might be a little bit too high in the US or in Britain or
Britain. Let's say because I'm Britain. Moment we've got 5% bank rate. Now that is actually 1 point below the long-term post-war average of bank rate, the Bank of England's rate. At 5% interest, the average UK household has so much debt now, given the inflated house price, that 5% really translates into, I'm saying roughly 15 or 16% back in the early 1980s when households had 1/3 as much debt. So you can see that a 5% rate in this country is pretty painful, and it's rough. And in terms of household income going on on mortgage payments back to where Britain was in 89 at the end of a housing boom. We had a 3 or 4 year housing bust, quite a deep recession. And we've also had this week, which is interesting, one of the water utilities, Thames Water, biggest water utility, 50 million customers, heavily financially engineered, 14 billion of debt on 1 billion of cash flow. And, it's about to go bust. So these are things anyhow that I look out for to say, well, is it over? And I think not. I think that well, we'll see. I just think that either I think the central bank's going to have to start loosening pretty, and if they don't, I think that they pursue a narrow inflation target. In other words, obsess about the 2% inflation target. They will really find themselves like the central banks, under the gold standard, which were blamed for the Great Depression, where they, the Fed had I can't remember what it was, late 31, forced to raise rates because, to maintain the gold standard, and that being blamed for creating the banking crisis. So we'll see, but I think it's difficult.
We will see. Well, Edward, thank you so much for coming on, sharing your insights, talking about the book. Of course, the book is The Price of Time. And, for people who said, oh, I listened to this interview, I know what the book's about, so I don't have to read it. They are totally wrong. There is so many gems in here. And so they should check that out. And also, your one of your previous books, Devil Takes the Hindmost, which I read, is also fantastic. So folks should check that out. Edward, thanks so much for joining us. Joseph, thanks for joining us as well. And thank you everyone for watching.
Bye then.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.